Welcome to the webinar today. Hope everybody is well. So let's look at the market. What do we have here? For the most part, not a whole lot's going on this week. We're at 3371. We're about 14 points off the high. The VIX has come down in the last week or so. We're at about 1430, still in an uptrend. VIX is kind of come down a bit over the last couple of weeks. And ATR, which measures the size of these candles, the high-low range of the day in SPX, we're still getting some turbulence, but it's been trending down. And so the ATR, which we look at, more of a metric to give us comfortability in short-term trades, maybe 7 to 15 day, is definitely coming back at levels where we would consider doing short-term trades. So we're at this. Here we are again, still in an uptrend. Markets near all-time highs. VIX, I'd expect that you would think if you're at all-time highs, VIX should be 11 or 12, but it's higher because we've been going up with some speed lately to the upside, and I think people are nervous about the downside, so they're willing to pay something for out-of-the-money put. So I think VIX is a little higher than I would think it would be with us at 3371. But it is what it is. So I'm going to look at 2 or 3 trades today that are interesting, that maybe that I'm looking at. Again, I'd probably wait till Tuesday to put them on, just because you have a 3-day weekend. Why take the weekend risk? Unless something looked phenomenal, why take the weekend risk on a range-bound type trade? But these are based on the current weather conditions, things I'd be looking at. For those of you who might not have been to a webinar with us before, I just give you a little bit of perspective how we look at life here. At Sheridan Mentoring, you look at a complete option, so I'll just give you a little bit how I look at life here, and then we'll get into trades, and it might make a little more sense. So there's no trading on Monday, I believe, or President's Day, so the market will be open on Tuesday. So the way we look at kind of a complete options portfolio, we might break it into 3 pieces of a pie. We would have your income portfolio, at least that's what I call it. That would be kind of your ranged-bound strategies based on probabilities and decay, like iron condors, butterflies, for the most part, calendars, double calendars, kind of range-bound stuff. That's one part of the portfolio. And again, just trying to put this all into perspective for you, give you a 5-minute capsule of kind of how we look at life. Let's say you had a $50,000 portfolio. How might I look at this? Divide it between income portfolio, long portfolio, and spec, and then cash. And I'm talking about non-portfolio accounts, non-portfolio margin accounts. I'd look a lot bigger cash if it was non-portfolio margin. But so income portfolio would be range-bound, looking at range-bound trades based on probabilities and decay, and we'll kind of, based on volatility levels, we would allocate more towards maybe strategies that would benefit if volatility were high, iron condors, butterflies, kind of looking reversion to the mean. Volatility's going down. If volatilities were, 16, 17, 18, we'd be doing more kind of butterflies, iron condors. About a week ago, or a week and a half ago, applied volatilities were, the VIX you're talking maybe 17 volatility. 18ths we're doing more, a little bit longer duration, butterflies and iron condor. So this is more your range-bound stuff, kind of the bread and butter, what we do here at Sheridan Mentoring. We do short duration, long duration. And basically when these candles aren't too big, we'll do some a little more short-term, but lately you can see the candles are pretty big. So in the income part of the portfolio, on a sample 50K portfolio, might be 50%. Right, as of now. 50%, kind of what we've done lately is more 30 to 45 day stuff, less short-term stuff until probably now, because this ATR, which measures the high-low range of the day, it's been a little too volatile lately, and now it's just calming down. So, but that's what we've been, about 50% income portfolio. The long portfolio, we're still looking maybe 20 to 25%. What is long portfolio? The view of an investor, long term. I like Costco or Microsoft over the next 2-3 years. I'm going to put on a, put credit spread or long diagonal or covered right every month. It's that view. It's not spec. Saying I like this, I'm going to be intentionally neutral to bullish position on every month. That's the long portfolio view of an investor, and we're lower. Why would we be lower percentage? We're 50% of this for income. Why do you think I'm lower? Why do you think I'm lower? How many of you, if your broker called you up today and said, look we're at all-time highs, and this is the time to get long with most of your money, what would you say? You'd say, hey, I've been around. No, I don't want to be fully allocated in stocks at this time, even though the stocks are going up, so a little less. In December 18, when we've corrected 20%, our long portfolio number allocation might have been 50 or 60%. So that's long portfolio. What's in a long portfolio? Long stock, long leaps, long mutual fund, put credit spreads, covered rights, cash secured puts, long diagonals. You get the idea, neutral to bullish, certain types of broken wing butterflies with little or no risk on the upside. So I would say we do more of this. Second, we do this. And then third, everybody's favorite, spec. What's spec? Spec is where you wake up in the morning, put your pajamas on and your cup of coffee and say, I have an opinion. The opinion could be based on pizza from the previous night. It could be based on Fibonacci, Gubinacci, a dream you had, a chart, fundamental. Spec is, I have an opinion, right? Spec, we might put 10%. Sometimes you might put more. I mean, if the market's going one way for 3 years, can it make some of you look good on your spec picks? Yes or no? If the market goes one way for 3 years, can it make some of you look like geniuses on your spec trades? Yeah. And you go around and you tell your neighbors, I know which way the market's going. Oh, you're brilliant. Right, market's been going up and you've been, putting on some spec trades. You're a genius, of course. So let's see if I add the numbers up. 50, 20 is 75, 85, and maybe 15% in cash for adjustments and stuff like that. If you have a portfolio margin account, because it's more risk-based, I'd probably put 50% in cash. So that's our perspective. And again, how is our outlook in Sheridan Mentoring different than probably 99% of the brokers and 99% of the educators and newsletter people out there? Because we don't wake up in the morning with our pajamas on screaming, I have an opinion. Not that we don't do directional stuff, but we're more non-directional. We treat this as a business. We believe you can do this when you work on the craft. You've done 30 butterflies or calendars. We believe you can do this for monthly income if you're disciplined. And so we're doing this based on probabilities, decay, more volatility based in terms of making decisions. But that's how we're running a business, like an insurance company. Where still most brokers in this age, and even most newsletters, they look at a chart, and a lot of them look good right now, just because we've been just going one way, right? We look at a complete diversified portfolio, have an intentional plan, and put these trades on in the income part of the portfolio, same vehicle, same strategy, put it on every week, every other week, once a month, until the cows come home, right? Like a surfer. I'm going to Huntington Beach next week. I've got a couple seminars. This triggers that I was going to tell you an analogy, but I'll tell you, for any of you living in California, we'll be in Huntington Beach Central Library next week, 20th. From 6 to 9 at night, you're welcome to show up. Come to our front page, Sheridan Mentoring, sign up. It's a free 3-hour webinar. It should be a lot of meat, usually when I do a seminar. But the point is, with the income part of the portfolio, right, we're keeping our opinion out of it, right? And it's just practice, right? The income part of the portfolio. We're doing this stuff all the time. We have metrics, right? It's like, let's say I go surfing every day, and the waves are 4 feet, 5 feet. I go surfing every day, but I've got metrics. If the waves get 7 feet or 8 feet, I'm not going to be in the water anymore, right? Or I'll move out. Same thing here. We're in playing. We'll do the same strategies. We'll tweak them based on volatility and stuff, but we're in every week doing this stuff, right? Rain or shine. But we have metrics. One we may be longer duration, one we may be shorter. When we would do butterflies, when we would do calendars. When we would stay out of the water, when we come into the water, right? So we're doing this, but we're not doing it mindlessly. As Harriet said, Huntington Beach is the Thursday the 20th. Thank you. Oh, did I say Wednesday, Harriet? Thank you. Yes, Thursday the 20th. And bring your surfboard. We'll be there. So anyways, that's a perspective of how we look at the options business and run it. So I don't have to watch Jim Cramer every day. I don't have to sleep with charts in my bed, right? And figure out which way we're going, right? We do spec, and we have different speculative trades. I think it's very difficult to make a living, a consistent living, whether it be $3,000 a month or $10,000 a month, picking the direction of the market on a monthly basis, right? I think for a period, sometimes you can do it if the market's one way, right? Over a year or 2 years, very difficult. This is more like a business. And the key here is basically discipline, risk management, and practicing the right way. And I think a lot of people have trouble with being consistent and disciplined, don't they? Now, with all that out of the way, let's look at a few strategies. First, let's start out. I'm going to do something from the long portfolio, the view of an investor. Well, Matt had a question. Out of all the option traders, what percent would you say trade like a pro this way? The retail option traders, I'd say maybe 5%. Even the people that trade similar strategies like we do, they don't trade them like we do, right? They'll maybe be more directional, or they'll trade them sometimes, or they'll need some volatility. We're in, right? Whether the volatility is high or low, we have strategies of volatility is low, strategies. We're in. Here's the question. If you could today, you say, you know what, Dan, I have some extra money. I got an inheritance. I'm going to buy 100 shares of one of these 3 stocks today. I'm going to hold it for 2 or 3 years because I think it'll be higher in 2 or 3 years. Which one would you do it? Costco, Walmart, or Microsoft? Pick one. Since this is my question, we go with my 3. Out of those 3, which would you buy 100 shares in, and you think it'll be higher in a couple of years? Costco, COST, Walmart, WMT, or Microsoft? Only pick one. It's got to be one of these 3. Okay. So you guys, most of you take Microsoft. So what's the long portfolio? The view of an investor. Am I asking you which way Microsoft's going in the next hour? No. Am I asking you what it's going to do the next week or 2 weeks or month? I'm not asking you that. But if my view is I like Microsoft over the next, 2-3 years, we're going to do something out of the long portfolio every month for the next 3 years. It doesn't mean short term we might have, and I'll tell you how I'd set it up in this environment. Because in this environment, I'd be a little defensive, even though I might be bullish Microsoft for the next year or two. Short term, I'm defensive because the market's at all-time highs. If SPX goes down 4% in the next 2 weeks, will it bring down Microsoft too? Yes or no? If the market goes down 4 or 5% in the next month, will Microsoft go down with it? Yes or no? Of course it will. So So I'd be, even though I'm bullish on Microsoft over the next 2 years, short term I'd be a little defensive. You get the idea? So I'm in Microsoft every month the next 2 years with a long portfolio strategy, covered right, long diagonal, right? And most of you, that's not in your thinking well, right? You're thinking, hey, let me look at a chart. Hey, how does Microsoft look the next 2 weeks? I don't care, right? This part of the portfolio is the view of an investor like your retirement account. So here would be a long diagonal, and I'm looking at Think or Swimmy, or is it TD Ameritrade, or is it Schwab? Or next week someone will buy Schwab. What do you think? I'm going to sell the March 16 expiration. Let's sell the March 20 expiration. That's 35 days out. I'm going to sell the March 20 expiration 35 days out. So basically what I'm doing is a covered right alternative. I'm going to buy an in-the-money call instead of buying stock. Why? Because if you do a covered right in Microsoft today, approximately how much is it going to cost you? Put the stock at $184. If you do one covered right, buy 100 shares of stock, selling out of the money call, what's it going to cost you? What's it going to cost you? Give me an approximation. About 18 grand, right? To do one stinking covered right. For a fraction of that, basically the same strategy, if I just substitute buying an in-the-money call instead of stock, I can save myself a fortune, right? So here's what I'm going to do. How am I going to structure this? I'm going to sell the March 20s 35 days out, and I'm going to buy the April 17s 63 days out. You with me so far? I'm going to buy the April 17s 63 days out. I'm going to sell the March 20s 35 days out. All right. I've already declared my allegiance to Microsoft over the next 2-3 years, and so did you guys. But are we concerned about Microsoft? How many of you are a little bit concerned about the price of Microsoft over the next month because maybe some vulnerability a little bit in the market? Anybody? Any of you think a little concerned about? Okay, me too. So even though I'm bullish on Microsoft, how do I set it up a little defensively? What's the answer? I sell an at the money or an in the money call, right? That's a warmer blanket in the winter. So if we're at about 185 in Microsoft, if I were to sell the 185 call, I'd get about $6.50 of downside protection. What if I sell the 180 call? Instead of 6.5, I get almost 9.5. That's even a warmer. That's even a warmer blanket. What if I was concerned to the point my toes were wiggling? I could sell the 175s 10 points in the money. That'd be a little more drastic. But let's say we sell the 180s 5 points in the money. So against my long call, I'm going to sell something $9.50. That gives me a little bit of downside. So I'm going to sell the 180s as a delta of about 62, right? A typical covered right or a typical long diagonal, you sell the out of the money call. But if we're a little concerned for whatever reason, even though I'm bullish long term, short term, I want a little more protection. I'm still going to be long delta, can still make money on the upside. So first piece of the puzzle, I'm going to sell the 180 call. Now, which call do I buy? Oh, I did that wrong. I was looking at the wrong expiration. I got to go to the March 20 and do that. That looked a little too good, didn't it? I go to the March 20. I'll get to a question in a second. Aren't you worried about assignment for selling in the money calls? Absolutely not. I'll explain why. So I'm selling the March 20s, or I'm selling the March 20s. And if I sell about a 60 delta, let's see here, I'll sell the 180 call. It's $5 in the money, right? March 20, so the 180s. And then I'm going to buy the April 17s. I'm going to buy, in this case, I'm going to buy the 175 calls. Again, remember, a covered right in Microsoft costs about $18,000. This long diagonal is going to cost not $18,000. not $10,000, not $5,000, not $2,000, about $500, this version. Now, this was more defensive, right? This is the price of the underlying. This is the upside. See, it goes down a little bit. Look at the downside. This is the expiration graph. So I got a lot more room on the downside. I'm 7 deltas long. That's by selling an in the money 180. Well, what if I wanted to sell the at the money? Instead of being 7 deltas, if I sell the 185, instead of 7 deltas long, 22 deltas long, right? So it looks prettier on the upside, but not as pretty on the downside, right? Here's the underline. If I was more bullish over the next month, instead of selling the at the money 185, I'd sell the out of the money 190. Then I'm really long deltas, and I really do well if we move up. Here's the underlying. I'd be 38 deltas long, right? But choosing to, hey, I'm a little concerned with the downside. I still want to make some money on the upside. I want some more downside protection. That's an individual choice on a monthly basis. So 3 people can say, you know what? We all like Microsoft over the next 2 years. We'd buy 100 shares of stock and hold it. But short term, one guy might be bullish over the next month. One guy might be neutral. One is bearish. That's all acceptable under the United States Code of Ethics. I'm selling the 180. I want a little more downside. I'm 7 deltas long, a little bit of positive theta. This is the underlying. Here's how I look at it, Trivet. When he said, aren't you worried about assignment for selling in the money calls? Not that it's exactly, and excuse my bad sense of humor, but it's like, how many of you are worried if you win the lotto tonight, you got to pay taxes on it? How many of you, it keeps you from playing the lotto because if you win $1 million, you got to stink and pay taxes. You got to call your lawyer. What a pain in the butt that will be. You agree? I'm joking, right? The point is, if you get assigned on a short call in a covered right or a long diagonal, are you making or losing money usually? Is it a good problem or a bad problem? I'm just taking the result. If you get assigned on a short call, should that be your worry in a covered right or a long diagonal? Should you be worried about, are you going to get assigned on the short call? No. If you get assigned on the short call, will it be an inconvenience? Yes. Will it be a P&L problem? No. Is there a way, is it mystical when you're going to get exercised on the call? No. Can you as a retail trader figure it out? Yes. Part of it is not having a plan. That's why people get assigned. But you look at it, let's go back and look at the call we're selling, right? Let's look at the call we're selling. This is the call we're selling. We're selling let's answer this question by looking at the call we're selling. So this is what we're selling, the 180 call. It's in the money. Going for the bid is 780, the ask is 790. This is the extrinsic value. Everybody know what extrinsic means? So with Microsoft at 184.54, the intrinsic value is the price of the underlying less your strike of 180, right? Out of this current price, around 780 to 790, about $4.50 of that is intrinsic value. It's already got built-in value, right? The rest of that number is extrinsic value or time premium or juice or whatever you want to call it. So as long as there's that kind of time premium, and nobody's going to exercise your call. If they do, send them some candy, some flowers, thank them. If you're concerned about getting assigned and you don't have a plan whatsoever, just when that extrinsic value starts getting under 70 cents, ask yourself, look in the mirror, get a mirror. Why am I still in this trade? Right? It's probably in the money. Roll it. Do something. But when do you normally get assigned on a short call? When there's no more extrinsic value. So are you allowed under the laws of the Geneva Convention to watch the extrinsic value and as it gets under 70 or 60 cents, oh, maybe I should get out of this or roll it? Yeah. So should you hold this? Should you hold the, now again, I'm going to get into the strategy in a second, but that's the answer on that. Here's the bigger question. Why are you in this till 2 days before expiration? Why are you letting it expire? Why are you still in it as it gets in the money and your extrinsic value is going away? And what's usually the answer? I don't know. I didn't have a plan. So let's look at this and make a plan. Remember the song from the 70s? Make a plan, Stan, right? Something like that. So here's our plan. Now, this is only just an example. This particular one is $5. Here's the underlying. And you can see on a $500 investment, this is the P&L, you can see on the expiration graph, which is the green graph, there's plenty, it gets to near $100. It can get up to $200. And so that's all on an investment of $500. So you're talking about 20 to 40% return. But what if we're looking for 10%? This is a covered right alternative. Covered rights, if you're lucky, the best I've seen a covered writer do, maybe get close to 1% in a month, correct? The best I've seen a covered writer do is get close to 1% in a month. With long diagonals, which is basically the same strategy, you can get close to potentially 7 or 8% because you're not, or more, because you're not buying the goofy stock. So if you look here, if our debit is $5, right? $5 debit, and we're going for 10%, 10% of 500 is 50. I'd sell it out at $5.50 credit, right? I sell it for $5.50, make $50 divided by 500 for every one I do, and make 10%. And then the other side is simple, not getting into adjustments today, but let's say I don't want to lose too much more than 10%. So if this goes to $5.50, I get out. If this goes under, let's say $4.40, get out. And if you're doing this every month, you're going to win a lot more than you lose, and you'll keep your losers under control. So that's a basic risk management without getting into adjustments. That's a plan. So this would be more of a defensive long diagonal where your short is in the money. That's why you have this type of graph, right? If I sold the at the money or out of the money, this part would be lifted up. I'm making money on the upside unless Microsoft goes crazy. But again, this is Microsoft. Does that make sense to everybody? Kind of how to structure, giving you a basic rundown on a long diagonal. You could use this doing the index, not to worry, again, assignment shouldn't be your biggest problem. But again, the bigger question, Sonny, shouldn't be assignment. It's like, Sonny or David, do you have a plan? What are you going to do if it goes down? What are you going to do if it goes up? What's your profit target? These are the things I'm talking about. Your biggest concern should not be assignment. Your biggest concern on long diagonals and covered rights should be, what if this thing goes down a lot? What am I going to do? So with the diagonal, if you look at the graph, what are you hoping for? You're hoping, if the stock right now is at 184.77, the stock is 184.77, what you're basically saying is, if the stock is basically over about 177 or higher, you make money. So that's what you're hoping for. If you look at this trade, as long as we're around 177, this is the expiration graph, or higher, you're making some money, right? So do you make money if Microsoft doesn't do anything? Neutral, yes. You make money if it goes up, yes. Do you make money if it goes down? Yeah, you got to 177. How much room is 177? We've got almost $8. So 8 divided by 184.78. So here's the scenario here. Yes, between now and March 20. We make money if it goes up. We make money if it's neutral. We make money if it goes down. We make money! How do we lose? If Microsoft is more than 7% down, but that's a pretty good trade, right? In terms of, and if it's a stock you like, over the next till March 20 expiration, we can handle a 7% move down, neutral, and up. There's other you can do credit spreads, different things, but volatilities are a little bit in the lower end of the range, and I like long diagonals. They get you a little bit of long vega, which means if the market goes down, volatilities go up, you don't lose as much. How did I compute the 177? All I did is I looked at this. The green line is my profit line at expiration. When's expiration? Expiration's in 35 days. Why? That's when the March 20 expires. So how did I get 177? I looked at the graph and said, where am I basically making some money from? You could see here about 177, maybe a little bit lower. The break even is here, 175.79, but I said between 177 all the way up, 177, I'm making some decent money. Again, this is a $500 adjustment. That's all I looked at. I didn't want to say break even because we're not really making money at break even. So like 177 and up. So again, that's pretty good. You get 7% downside. You make money if it's neutral or up. That's a lot of scenarios. Does the trade expand within? Yeah, if the volatility goes up because you're long vega, you'll make some money from volatility. But on the downside, you'll still lose. You'll just lose a little bit less. Dan, can you find me a trade that I can put a lot of capital into that makes money if it goes up, makes money if it's neutral, makes money if it goes down? But Dan, I want to make money no matter what happens. I want to make good money every month. What should I do? Here's what you should do. Immediately close down this webinar. Get in your car, drive to Disney World, go to Magic Kingdom, and say, Dan Sheridan sent you. And they'll say, oh, you must be a dreamer. What are you looking for? Well, I want a strategy that makes money 8% a month with no risk, and it makes money all the time. And they say, you're at the right place. Come on in. All your dreams, what's Disney World? All your dreams will come true. But outside of Disney World, what we try to do in the options world is create strategies with good risk-reward ratios, good risk management, and decent trades. You guys buy houses, don't you? Any of you own a house? You have risk in a house. Is your house allowed to go down? Right? Most people think no. And now we're in one of those scenarios, of course not. But about how many years ago? You couldn't give houses away. So whether you think there's risk in things you own or not, there is, right? I was going to go over 3 strategies, but that's not going to happen. We went over one. It was good. Took our time with it. Next week I will be out of town, but the week after I'll do another webinar. We'll continue our discussion here. There's no slides today. We just went over long diagonals. I think very appropriate with the market at these high levels. You know, whether you're a covered writer or a long diagonal, which to me is a more efficient way of doing covered writes, you should consider getting a little more downside protection. One last thing I want to share with you, I think would be good if you like this type of teaching and you want to learn more of the craft of option trading. We're running a trial right now for 1 month of Sheridan education, which would be a couple hours a day of teaching from Mark Fenton and myself, just like this, more specific. I'm probably putting on 4 or 5 live trades a week and go over risk management on it. Sometimes I put on less live trades, sometimes more, but we're teaching you. You're seeing what we're doing live. It's recorded, the sessions, and also sending out like a couple emails a week on the trades we're doing. So, folks, I'd encourage you, if you like this type of teaching, do the $49 trial. I'd love to have you. If you live in California, and I'll be doing 2 free seminars out there next week. Would love to meet you. Have a wonderful weekend, and we'll see you next time on our weekly webinars. Have a great day.